Investors are pricing grid risk. Most companies aren't disclosing it. There's a question showing up more frequently in investor conversations that finance and ESG teams aren't fully prepared for. It isn't about emissions targets or diversity metrics or board composition. It's about power. Specifically, how exposed is this company to grid constraints? What happens to its operations, its capital plans, and its growth projections if reliable electricity isn't available when and where it needs it? Those questions sound operational. They are increasingly financial. And the disclosure infrastructure most companies have built to communicate with investors wasn't designed to answer them. Why energy access is becoming a material investor concern. The numbers behind this shift are worth sitting with for a moment because they tell a specific story about the direction of travel. The EIA's January 2026 short-term energy outlook projects electricity consumption will rise 1% in 2026 and 3% in 2027. That would mark the first 4 consecutive years of growth since 2005 to 2007 and the strongest 4-year stretch since the turn of the century. The EIA specifically attributes part of that commercial sector growth to large computing facilities, including data centers. This is not a one-sector story. It is a broad, sustained shift in how much power the economy is drawing. The supply side is not keeping pace. In the PJM interconnection region, which covers the U.S. East and Midwest and serves roughly 65 million people, projected demand growth through 2030 is 32 gigawatts. New gas-fired generation currently in the queue through that same period is approximately 6 gigawatts. Coal retirements over the same window are projected at 18 gigawatts. The math there is not comfortable, and investors with exposure to companies operating in that region are starting to ask what it means for their portfolio companies specifically. The interconnection queue data from Berkeley Lab adds another layer. As of the end of 2024, approximately 10,300 projects were seeking grid interconnection, representing 1,400 gigawatts of generation and 890 gigawatts of storage. The median time from interconnection request to commercial operation has doubled, from under 2 years for projects built between 2000 and 2007 to more than 4 years for those built between 2018 and 2024. Projects that used to move on a predictable timeline are now carrying schedule risk that directly affects when and whether a facility can operate at full capacity. What investors are asking that disclosures don't answer. Investors are paying attention to all of this. According to PwC's 2025 Global Investor Survey, 68% of respondents said they would at least moderately increase investment in companies actively managing energy demand and infrastructure. Separately, 84% said companies should maintain or increase investment in climate adaptation. Those two numbers together signal that the investor community is not just watching grid risk abstractly. It is actively trying to direct capital toward companies that are managing it well. The problem for finance and ESG reporting teams is that current disclosure frameworks weren't built around energy access as a material risk category. Most ESG reports cover energy consumption, renewable energy percentages, and emissions intensity. They don't typically address interconnection queue positions, power purchase agreement termination exposure, grid reliability assumptions embedded in capital plans, or what happens to facility operations under constrained supply scenarios. Those are the questions investors are starting to ask directly. And when the answers aren't in the disclosure, investors either have to make their own assumptions or escalate to direct engagement, neither of which is efficient or flattering to the company being asked. The disclosure gap matters in a specific way here. Energy-related financial risk is increasingly being treated as a component of climate risk assessment by institutional investors and rating agencies. If a company's grid exposure creates operational or capital risk that isn't being disclosed, it registers as an information gap in the risk assessment, which is itself a negative signal. The bridge between this week and next. This is also where the week's broader accountability theme lands in a specific financial context. Companies that have been treating energy access as a facilities management issue rather than a disclosure and investor relations issue are about to face a version of the same scrutiny that has been building around emissions data and ESG reporting more broadly. The pattern is familiar. An issue that lived in operations gets elevated by investor interest, regulatory attention, or both. The companies that get ahead of it build the data infrastructure and reporting framework before they're asked. The ones that don't end up answering harder questions under worse conditions. For finance teams heading into the second half of 2026, that means two things worth doing now. First, map the company's energy access exposure. Where are grid constraints already affecting or likely to affect operations, capital timelines, or growth plans? Second, assess whether current disclosures give investors the information they need to understand that exposure. If the answer to either question is unclear, that gap is worth closing before an investor asks about it on an earnings call. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.